Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Excuse me. Well, welcome back. Got a lot of good stuff to talk about today. Feel free to call us 216-901-0945 if you have any questions you'd like to ask. Not a problem. If you go to my website, there's a contact us form. If you hear something you'd like to know more about, please feel free to give us a call or drop us an email. There's a contact us form there. You can fill it out. We'll try to get back to you as quickly as we can. And I just want to let everybody know, I run a model that I haven't had for an extremely long time period. It's relatively new. It involves exchange-traded funds, the ones that have the highest risk-adjusted returns in their categories. And they've also got the lowest expense ratios. So I put that together. We're using it. It's one of the models that we use. And if you'd like to know more about that, feel free to give us a call. One of the reasons I'm pointing this out is that it has a fairly significant exposure to emerging markets and international markets, which are doing quite well now, which haven't done well for a very long time period. Actually, all the way up to this year, they've been lagging the S&P 500 and U.S. stocks in general for a long time, almost 5 years. And this is why this is significant, because in the super long run, if you go back 100 years, all these stock markets around the world, shouldn't say all of them, but most of them have very similar returns. They're within 1 or 2% of each other. In fact, the German stock market has a higher long-term return than the United States stock market does, and they lost 2 world wars. But anyway, so if you're looking at that and you're looking at the fact that now they're starting to outperform, I think it's time to start looking at those areas and start making additions to those portfolios. And that was one of the reasons I was kind of glad that the Department of Labor rules that came out recently that they've put on the shelf for now. Eventually, they are coming back anyway. But right now, they talk about funny. They said we're going to have to do all this stuff, and they're threatening everybody. They're going to put them out of business if you don't follow these rules. And then they're saying, okay, we're just kidding. Nah, we're not going to put that in place right away. And I know why. We wouldn't even talk about that stuff. Anyway, it was a lot of effort, and I think that it was good because it forced us to go out and look and include some of these asset classes that we may not have had much exposure in, and it's helping. And it's not by design, it was luck. They came out with these rules at that point in time, but it's helping. And I think if you're not including those categories, well, you're missing out on something. And like I said, in the long run, the categories are all very, very similar. They're very similar as far as returns go, which kind of blows your mind, actually. Anyway, long story short, if you'd like a copy of that model that I'm talking about, just email me. I can email you a copy of it. It's an illustration there. It's a hypothetical illustration. There's about 8 pages of disclosure on it. You don't have to read those, but take a look at it. I think it's really fascinating to see over the last 5 years how somebody would have done utilizing these various funds that exist. And they're all at least 5 years old, by the way. And that's one of the kind of criteria. You generally want to use a fund that's really new, may not exist 6 months from now. A fund that's new, it happens all the time. A fund will come out, an exchange-traded fund, mostly exchange-traded funds, by the way. The mutual funds generally are issued by mutual fund companies who have enough money from their other funds to keep them in business until they attract enough assets, although not always. But more often than not, a mutual fund will hang around for a while longer than an exchange-traded fund. And one of the reasons that the exchange-traded funds go away so quickly is because their expense ratios are pretty low to begin with. They don't charge a lot of money for what they're doing. And so they've got to attract assets very quickly. If they don't attract assets quickly, they'll just shut the fund down. And that happens every week. In fact, almost as many new funds come out as go away, almost. But so if a fund hasn't been around for 4 or 5 years, or at least 3 years, and it doesn't have over 100 million in assets in it, the chances of that fund staying around is pretty remote. So if you've invested in it, they're just going to give you your money back. That's what they do. They deposit the money right in the broker dealer when they shut that fund down. And it's happened to me, I don't know, 3 times. And 3 times, is 3 times too many as far as I'm concerned. But then I have to go around and look for another fund. So that's one of the reasons when I did this hypothetical illustration that I used a 5-year period. They got to be around for 5 years. And they have to have a certain amount of assets in them, because it's very aggravating when you get your money returned to you, especially if you have large short-term capital gains. That's really aggravating. Now you've got your money back. You've got to find another place for it, and you're going to get a big tax bill at the end of the year because you had a profit in it. And that happens, by the way. And having mentioned that, I still haven't decided what we're going to talk or when we're going to talk about. We haven't heard back from the venue that we want to use for our January seminar, but we are going to have one, and I'm going to talk about that model. We're working on a couple of others. I'm always working on models. I think in my own portfolio, I've got about 6. I have 6 of them. Because I don't like to invest. I don't like to have my clients investing in something that I don't have money in. That is, so I put my money where my mouth is. If I'm going to talk about it, I'm going to have money in it. And if I decide to shut it down, it happens occasionally, not very often, then I'm going to be selling too, just right alongside you guys. So, but we are going to talk about some individual stocks as well. And it's the beginning of the year. 2018, I'm moving my facility about a mile away, and the building I'm moving to has an agreement with other buildings, and we have access to some meeting space there. So because I really like doing what I do, I really like doing the scans on individual stocks every day. I still have a big chunk of my own money invested that way. I haven't been able to do that for clients for a while because the technology with the custodians that I'm using today wasn't good enough. But I've been exploring using interactive brokers, and it looks like their technology will allow me to do some of the things like that I've talked about and shown you over the years. And I used to run a big portion of the money that I managed that way. Now, so I might be able to bring that back. I think I can. And matter of fact, I'm pretty sure I can. I just have to work out some details. So that's why I'm talking about it this morning. Probably sometime in the first quarter. And for those of you that are longtime listeners, longtime seminar goers, it's the breakout stocks. That's kind of it's a modern version of what William O'Neill talked about years and years ago. He popularized that, by the way. William O'Neill was not the inventor, no matter what he says. He was not the inventor of the momentum investment strategy. That's silly. Okay. But he did come up with a bunch of very specific rules, and I'm going to tell you my rules are significantly easier than his. And if you can't learn this in less than an hour, you're either not paying attention, you're distracted, or you probably should not be handling your own money. You should probably hire someone else to do that for you, because it is easy. I mean, it's easy to understand. Easy to understand and easy to do, 2 different things. 2 different things. I'm going to tell you. I bought a stock yesterday. Okay. It opened up really high. The stock's been doing incredibly well. It gapped open, goes up, right where I think I filled about 2 cents off of the high of the day, right before it turned and went down 10% and stopped me out in the same day. Yeah, that hasn't happened in an incredibly long time period, but it happened yesterday. But despite that fact, the portfolio I managed doing it that way was still up for the day because some of the other stocks had gone up and it offset it. Now, that was luck. I mean, it could have gone the other way where a bunch of those other stocks were down too. That's going to happen. But I remember just laughing about it, going, oh, well, back to the drawing board. I'll try to catch it when it starts to rally again. And I really like that philosophy, and I'm really excited to think that I might be able to bring that back. I'm excited to bring it back for myself because there are people that have been requesting it for quite a while, and I think I'm going to be able to accommodate that. And in fact, I'm pretty sure I will be able to accommodate it, but it's going to be a relatively small group of people. And quite frankly, you're going to have to take a test. You're literally going to have to take a test to be included on this because I won't have time to stop and try to explain everything that I'm doing over and over and over again. Yeah, I can't do that. I can't do that and do what I'm doing. So you'll literally be required to take a test, and that's why we're going to do those informal meetings, because I'm going to train people on this. I'm even going to put the course up online. There's a couple different vendors. I haven't decided which one I want to use yet. One of them is called Teachable, and actually you can put it up on LinkedIn too. You can put a course up on LinkedIn, and that's kind of cool. And there are several others, but to set it up it's easier than it's ever been. It's easier than it's ever been to set up, to get the equipment that you need. No big deal. You're not going to be spending thousands of dollars on this. And if you really like investing, and by the way, this is for somebody who really likes investing, who wants to do this, wants to learn how to master it and put in the time. Okay, so if you want to put in the time, then I'm going to show you how to do that. It's not as much time as you think. And I think the hardest part is I'm looking at one of my favorite scans this morning. Yesterday, the market was only open for a very short time period. And I've got, looks like 12 stocks on a day when almost nobody's there, except for the people that were selling the stock that I bought. There's still 12 stocks, and you have to choose between them. Now, I'm going to teach people how I do it. I run a small fund, small hedge fund. It's not open to the public, at least not yet anyway. But I run a small fund using these techniques. And so I'm going to show you that. And I really like it. I really like it a lot. I know I talk a lot about different types of investing here. I guess I'm excited about being able to offer this once again. I haven't been able to offer this in years. Actually, about 14 years to be exact. So about half of my career. I haven't been able to offer this to the general public. Now, I'm going into it with trepidation. Believe me, there's trepidation. Why is there trepidation? Because it's relatively simple, and everybody looks at it and go, oh, yeah, that looks easy. So does boxing. Boxing looks easy. Okay, you step in the ring and take a few punches, it's not too easy. It's the same thing. Or professional baseball player. It looks easy. Yeah, just swing the bat, hit the ball. Wait till you see a 90-mile-an-hour fastball coming at your head. So the good thing about trading, long-term trading, is that there's no physical pain. You get no physical pain whatsoever. The mental anguish is at least as difficult as that of a professional athlete. So not everybody's cut out for it. Not everybody has time for it. But at least you'll get to learn exactly how it works. And by the way, the market's changed like a lot. It's changed a lot. And it's all computerization. The ETFs have changed the landscape of the market, and it's actually pretty good. I like the change. It does create a lot more activity. It creates a lot more activity in individual stocks. They're faster and more volatile than they used to be. The faster part's the good part. The more volatile part is the part that you have to try to get used to, and it all comes from training, preparing yourself ahead of time. And by the way, a value investor has to go through the same training. Somebody who goes out and tries to buy stocks that are undervalued, who thinks they're going to go up one day, like a lot, they're just as difficult. And I'll tell you why they're just as difficult, because when a stock is undervalued, it's typically because people have fear. They're afraid. the investing community is afraid. So if they're afraid, or they're just not optimistic, and now that I hear the music, I can't believe the first 15 minutes is over. Hey, you're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these commercial messages. And we're back. I was talking about a ton of things, and then I went back to my email, started looking at it. If you'd like to, you can email a question, bill@bullingtoncapital.com. I never put up a Twitter account. I doubt that I'll ever do that. But I may put up a text number where you can text in the future. I think I will. In fact, I know I will because I can write that off. So I'm going to get a phone just for texting on the radio show. That's hilarious. But anyway, if you have any questions, just go to my website, Bullington Capital. You can email me, bill@bullingtoncapital.com. I love getting questions from people, find out what they're thinking about. What we're just talking about is pretty specific, and I can't tell you how exciting it is for me to be able to bring something like this back, to be able to do this again after all these years. So it's stay tuned, as we're going to be talking about it a lot more. For the more traditional people, I'm looking at momentum investing, value investing. We do it all, and the key is to try to figure out who you are as an investor. That's not easy to do, because most people don't know enough about the various investing styles to know the differences so that they can match their personality up with the correct style. And that's a challenge. Big part of my job is education. I get people asking me all the time, hey, how come you keep doing these seminars? And if you come to the seminar, you'll see the same people, probably, 60, maybe 70% of them. And the reason that they come is because we change the topics, and it takes a while to pick a lot of this stuff up. It takes a long time to pick it up. And there are changes that occur. The market's not the same as it was when I started in this business. Are you kidding me? Yeah, market, like I was talking about earlier, market's made a lot of drastic changes. In fact, here's another company I bought yesterday. I don't know if this thing's going to go or not. I have no idea whether it's going to go or not. And it's a company called Gain Capital. It's got a relatively low price to sales ratio, was running up big time. This one I'm down on too for the day. It sold off earlier in the day. It came up on a scan about a month ago, and then it came back up yesterday. So I bought it, and I'm probably already down, 4 or 5% on it. It's not a big deal. But if it goes down 15%, I'll be selling it. And this stock's under $10, by the way. So it's a financial services company. And the financial services companies can sell for price to sales ratios in the 4 to 5 range. They get to that point at some point in time. So when you see one that's around 1, then okay, it's undervalued and the stock is moving up fast. That's my definition of the odds just fell in my favor a little bit. And I don't put a huge position on. That's the other thing. One of the reasons that rookie investors, people that don't do this a lot, one of the reasons that they don't do it a lot is they want to load up. I just want to find the one and I want to load up. No, you don't. Because the risk, if you're wrong, is you don't ever recover. And investing is about managing risk as much as anything else. That's one of the most important things. You have to manage your risk. You got to find a way of doing that. A value investor tries to find stocks that are good, solid companies that are not overpriced. And then they buy them and they hang on to them until they get overpriced. And then it might be 5 years, it might be 10 years. In the meantime, those stocks might drop significantly. Sometimes they buy a stock that looks really strong. You look at the balance sheet, the income statement, the balance sheets, looks like a great company. Stock's going down, so they start picking it up when it gets to an advantageous price or whatever they calculate. This is undervalued. And then it goes down even further, gets a better bargain, and they buy a little bit more. And then it goes down a little further, and then they buy a little bit more. And then 5 years later, they're wondering why they bought it because it's still dry. And you think I'm kidding? That happens all the time. That's why value investing is no picnic. It's tough. If you're going to be an investor, whether you're value, growth, momentum, whatever it is, you got a set of challenges. You got to figure out what those are. And that's one of the reasons I'm not a big fan of value investing. Like I'll find stuff occasionally. I think the last stock I talked about that way was a company called Rail. And it was right around $17. Well, it's at $15 now, and that's been well over a year ago. And it's been as low. Yeah, this was pretty funny. Hang on a second. I'll tell you where I got it. So it got down to $10.87. I'm talking around $15, $16 is where I'm talking about it, which is right where it is now, and it's been as high as 20. Okay, so and that's value investing. That stock's still undervalued, like by a lot, and it may stay there. And in fact, the business, I've seen good value stocks, quote unquote, go down and stay down so long that the business actually did turn crappy. And then they deserve that lower price. So value investing has its challenges. One of the reasons that I'm a big fan of rebalancing, having rules, you got to have rules. What are your rules going to be? I can tell you, you can ask me about each and every one of the funds that I use, each and every one of the strategies that I use. I can tell you exactly what they are. Exactly how a stock gets in, how a stock gets out again. If you don't know where you're a seller when you buy the stock, you shouldn't be buying it anyway. Think about that for a second. If you don't know where you should be selling a stock before you buy it, you should not be buying the stock. So you've got to have an idea of, if you're a value investor, of what you think it's actually worth. Peter Lynch talked about that all the time. And for you young people out there, Peter Lynch has the best track record of any mutual fund manager in the history of the industry. So look him up. I get so tired of young people who are so smart, or at least they think they are, and they come in and they know it all. Really? Why are you talking to me? I'm just kidding. But kind of. You need to look up. He's got a couple books out there. They're very good. Peter Lynch had an idea of where he would be a seller in a stock before he bought it. Now, thing is that he's got the best track record, one of the best track records in all the money management businesses. If he's got an idea of where he thinks he should be going when the stock reaches a certain level, don't you think that'd be a good idea for you to figure that out? I mean, if you put $10,000 in that guy's fund, it was worth over $300,000 in 13 years. That was it. And by the way, that's not one of the fake news internet stories. That's real data. You can look that up. You're not allowed to make that stuff up. Okay, so he retired, very young age, did very well. And I'm telling you, he knew where he's going to be a seller. Now, it's got to be built into your rules. That's what I like about the funds that I use. I like things that are clearly defined. Things that are clearly defined. When this happens, I do this. And that's what everybody really needs to have in their portfolios. And the other thing they really need to do is stop comparing yourself to the S&P 500. Unless you've got most of your money in the top 50 stocks in the S&P 500, you probably lagged the market over the past 5 years. So if you had all the top 50 stocks and you still lag the market, then that might be questionable. But if you have anything other than those stocks, they were all lagging. They all did. Not a big deal. You just have to know that. Now, you take a look at emerging markets. Emerging markets are still not back to where they were in 2007. This year, they're blistering the S&P 500. That's just this year. And that's, again, it goes back to knowing your strategies, knowing what you're doing. If you don't want to take the time to memorize that stuff, that's actually why people like me have a job. Because you come to me, if you ask me what I'm doing, and by the way, because of I'm an accredited fiduciary, that means I have to operate in your best interest. I have to operate in your best interest. When I get audited, they find out I'm not doing that, I'm gone. And I don't have hundreds of millions of dollars to hire those high-priced lawyers that you see on television to defend me. If I'm not doing the right thing, I'm gone. And anyway, so it's a good thing too. That's a really good thing. I think everybody should have to operate as a fiduciary. I think they should eliminate the commission business completely. Just get rid of it. And boy, I'm sure I'll probably get a complaint lodged against me now. Get rid of the commissions and just make it all based on assets. That way, if the assets grow, you get a pay raise. When the assets go down, you get a pay cut. Now, whose interests are you going to be looking after? See, if you're looking after your own interests, by default, you're looking after your client's interests that way. That makes sense? Just get rid of the commission business. The whole thing. All of it. You get asset management fees for assets under management, percentages. Get rid of all the commission business, and not most, but a tremendous number of your problems in that industry go away. So I think that's important. People ask me a lot, well, what should I ask financial advisors? Ask them how they get paid. That's what you really want to know. More than anything else. More than where they went to school. More than who their friends are. You want to know, how do you get paid? What do you get paid? I've had to disclose that from the get-go. They talk about this, the Department of Labor rule. Well, now you're going to have to tell people how you get paid. Well, guess what? As a fiduciary, you have to tell them that anyway. So a lot of this stuff wasn't all that difficult to get ready for. Some of the paperwork that they were requiring now was kind of nuts. But anyway, just get rid of the commission business and you get rid of a lot of the problems, that plague people. And anyway, as an individual investor, if you don't have some international emerging market exposure, if you don't have some international exposure, talk to your advisors, find out why. Somebody comes to me and wants to make a change, we make the change. There's no question. It's your money. And I'm going to try to give you the best answer I can. You ask me which funds I like, I'll tell you exactly which ones, the ones I'm holding. And we're gonna use those. I don't think it's a good thing. In fact, this year, where is this? I'm looking at. Wow. So this is just the emerging markets index. Whoo, that thing's up almost 40% this year. Wow, that's amazing. But like I said, if you go back to 2007, it still hasn't reached the old high that it was at in 2007. So if somebody was looking at that really long-term track record, they go, oh, I don't want that. And then guess what? This year it's up 40%. So that's something that's really important, I think. Got to pay attention to that. And I'm going to take a quick phone call if I can find the phone in here. Somebody moved it around. Yeah. Oh, it's on the other side. I'll get it. Yeah. Pardon me for a second. Somebody came in the studio and moved all my stuff around. Anyway, I got Jerry. Jerry, you have a question?
Yes. Good morning, William. Alrighty. The question I have, there's a stock that I've been in for some time. It's had a nice run. The name of it is Qualis, Q-L-Y-S.
I was thinking of you this week because that stock came up on a scan and I was going, Jerry. Oh, that is funny. It's running. So if I were to have it, now this is the kind of stock that.
Yeah. How do I I'd say at this point it's a momentum stock.
It is.
How do I when it's starting to run out of gas? Is it strictly on volume and the stock is faltering from a price point? Here's
the thing. You can't really know anymore because there are so many hedge funds out there and there are so many ETFs. In fact, I want to see something. I got this list up there. Okay. Qualis. Here are the funds that this stock is in. It's in the Advisor Shares Cornerstone Small Cap. It's in the Compass EMP Develop S&P something or other volume weighted index. It's in First Trust NASDAQ CEA Cyberspace, First Trust Small Cap Core Alpha. There must be, holy schmoly, this stock is a member of at least 150 ETFs. It's in at least 150 ETFs. And this is one of the reasons that momentum tends to work so well, because those ETFs are market cap weighted. Every time that stock goes up, those companies have to increase their holding, their position in that stock.
Oh, really?
That's yes. This is one of the things I was talking about. This is what has changed in the marketplace. There are so many ETFs. You don't get the same cup and handle patterns that William O'Neill talked about before. You get a stock that blasts off and takes off and doesn't look back. Until when somebody...
Until it doesn't.
Yeah, a big hedge fund may come in there, start shorting it. You may get a whole bunch of other funds that start selling. Once they get it to go down, when it starts going down, say 10, 15, 20% or so, all those funds have to reverse and have to start selling.
Get out of Dodge.
Yep. And that's why the trend following thing is it actually works better than it used to. But it doesn't work the same way that it used to. These stocks will skyrocket and then plunge. So
well, it's fascinating because the analogy was on that applied optomics or AAOI,
yeah.
whatever yep. How it's pronounced. It didn't seem like there was an end in sight, and then it fell just as quickly as it came up. Actually, maybe even faster.
That's what I'm talking about. You know, you get and you know what? The underlying fundamentals of that company have barely budged. The thing that's
I'm sorry to hear you, Bill.
The underlying fundamentals of applied optoelectronics have
barely changed.
Yes, they barely changed. The only thing that's changed is the share price, and I'm telling you, it's because of these funds. And so, yeah, but that's how the market changed. That's actually a pretty good thing, though, because if you put a trailing stop on your stock, you know, occasionally in a flash crash, you're going to get stopped out of everything in a day. So don't put all your money in something like this. Don't ever do that. That's dumb.
Of course not.
Yeah.
Of course not.
So, but it's working better than it has in years.
Well, that's encouraging.
Yeah, and mainly because you've got all these the ETFs, and they're market cap weighted. So when the market value of the stock goes up because the share price is going up, they have to buy it. By law, they have to buy it, which I think is, kind of crazy.
That's pretty cool. So, okay, well, thanks for answering my question, Bill, and I hope you and your family had a great Thanksgiving.
Thanks, you too. I'll talk to you soon.
Yep.
Thanks for calling. I hear the music. That means I have to take a quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned because we'll be right back. And we're back. Okay, I did a overall scan. I'm going to have to go back from Friday. There were actually a lot of companies that came up on that, which is interesting. And just what we were just talking about, you know, I think there's a place for momentum, and I spent a lot of time talking about that today on a radio program. And I'm going to tell you, I only keep about 20% of my assets in that. Only 20% because it's fast. You got to be there. When you get a flash crash, you do get stopped out of just about everything. But I don't put a tremendous amount of money in it. And I really do it because I like doing it, because the other strategies, they're all kind of quantitative. They are quantitative at this point. Quantitative, all it means is that there are some relatively simple math that you use to pick the stocks. And the simpler models have a tendency to outperform the more complex ones. So that saying, you know, oftentimes the simple answer is the best. The simplest answer is the best. The William Ockham was a monk. I forgot what century he lived in. He's the one that noticed that first. It was also a philosopher. And I can tell you, in the stock market, that is absolutely true. Absolutely true. Look at the S&P 500. That's not a complicated idea. Let's take the top 500 stocks by size, and let's weight them according to their size. We'll put more money in the bigger ones and less money in the smaller ones. That's basically what they do. Does that sound really complicated? Not that complicated. Now, since Vanguard didn't want you to know that's how easy it was, because they thought some people got there to try to copy it, now they come up with a big, it's a float adjusted. Come on. Yeah, all right, I know what you're doing. And that's all marketing. Reality is it's the biggest. The biggest 1,000. Here's something that's really hard to beat. Okay, super hard to beat. Take the top 1,000 companies by size, just the biggest 1,000. And instead of putting more money in Microsoft when it's $400 billion than you did when it was only $4 billion, which is what they do with market cap weighting, just put an equal amount into all 1,000 companies. Just an equal amount. So how do you know when to sell a stock? Well, when it drops out of the top 1,000. It's gone. See ya. Why is that important? Well, because you've got to have some method of knowing whether you want to hang on to the stock or not. And if it's not in the top 1,000, why do you want it? Why would you want it? It's not doing it. The company's not doing as well as the other 1,000. Why would you want it? That's a good reason to sell, right? And most people are looking for 4, 5, 6, or 10 reasons why they should sell something and 20 reasons to buy something. That's one of the reasons they don't do very well in financial markets, because they're looking for too much. They're trying to be right instead of saying, okay, over a large group, this tends to work out fairly well. In fact, if everybody in the country only put, let's say, 7% of their pay into something like that over the 40 some odd years they're going to be working in their lives. I was just thinking about all the people I know that don't work, but if you did that, nobody would need Social Security. They wouldn't even want Social Security. They would give it away. They would volunteer to give their payments to someone else. That's how successful that would be. If you don't believe it, do the math. Look it up, do the math. Anyway, that strategy of taking the top 1,000, it's actually done better than the S&P 500 over time. It's done better. And you look at it, it hasn't done better in the past couple of years, but it still hangs in there. When it lags, it doesn't lag by a lot. And typically, your better recovery periods come after the market corrects. And because they're equally weighting the smaller companies that are growing faster than the bigger companies are, sooner or later, that edge shows up, or at least it has. And that's an ETF, by the way. You can invest that way. ETF is EQAL. That's its symbol. You can invest that way if you like to do that. I have some money in that. So I understand that. That's easy. And it makes sense. Do you know how hard it is to get into the top 1,000 companies? The top 1,000. Do you know how many registered businesses there are in the United States? Last time I looked, it was a little over 70 million. 70 million businesses? Okay. And believe me, most businesses would like to make more money. Most businesses would like to grow. Most business owners would like to get rich. That's why they're in business. At least one of the reasons. And yeah, I understand. No, I only need what I need. And I like to tell me you would turn down a lot of business, especially if the business was very profitable and easy. Okay. So you wouldn't do that. But and life generally doesn't work that way, by the way. But if you're in the top 1,000, you've really done something. And to stay in that group is not easy. If you're in an industry, I was talking about this to someone this morning. I can't remember who it was. Anyway, if you're looking at tough businesses, wait till you see what Google's plans are. So I just subscribed for that free week for YouTube television, which I'm going to get, by the way, because then you get all the music that comes with that free as well. And these guys, Google is going to, at some point in time, try to provide internet services through airwaves so that you just have a little receiver in your house, just like your cell phones. They've got a distinct number, right? You'll have a distinct number for this little receiver, and it's going to power your cell phone, and it's going to power all your devices in your house, and you're going to get super high-speed internet. You're going to be watching YouTube TV for your TV. Now, I don't know that they'll put the other firms out of business. I know that the other firms are shaking in their boots right now. And if you haven't tried YouTube TV, you should give it a shot. Get free 7 days on there. You can watch TV on your cell phone, on your computer. Just get a Chromecast, put it up on your television. It's pretty awesome. And when they provide a wireless connection that's over 100 megabits per second, actually, I've heard some stories. I don't know if they're true or not, so I guess I just won't repeat them. But it's a big deal. It's a really big deal. Now, nothing is as constant as change. And when you put together a portfolio, you better hope your managers are keeping up with that change, because it's a tough thing to do. And don't always expect to beat the S&P 500, because when people are buying that, it beats just about everything, which is what they've been doing for 5 years now. They've just been pouring money into that because, quite frankly, a lot of them didn't know what else to do. They were getting such a big influx of cash, they bought it as a last resort. Oh, that's what I want. I don't know what else to do, so let's just do this. Really? Okay. At some point in time, like now, you start to see the emerging markets come up. If you don't have any exposure to that, you're probably already sorry this year. You're going to be really sorry over the next few years, because that thing has lagged for nearly 10 years. And remember what I said before. In the long run, all their returns are relatively similar. What does that mean? Well, if the returns in the long run have been really similar and one has been underperforming for several years, what would you expect it to do in the future? What does it have to do to catch up and close the gap, the 100-year record that it's got? Okay. And an emerging market's probably not 100 years old. But anyway, a decades-long record that it's got. In fact, their returns have actually been higher if you go back to the inception of those indices. So if it's been underperforming over the past few years, which in stock market terms is really not a long time period, for the average individual, they think it's as bad as Methuselah. It's not. In the grand scheme of things, it's not a long time period. So, and if those companies in those countries who are growing faster than ours have lower valuations and better growth rates, what's the obvious conclusion there? It should be that you've got some exposure. You don't have to put all your money in there, but you should have some. And I think it's going to help. It's been helping this year, that's for sure. I love the international too. A lot of old school companies that have been in there, and boy, that thing's really done well this year. It's this year so far, it's up about 22%. Not too bad. Also has a longer term track record, very similar to the United States. Also, since 2014, has been underperforming in a pretty big way, and also not back to the high level that it reached in 2007. So if you were to look at a long-term chart or long-term returns, you might get disappointed because you don't know any better. You're going to get disappointed because you just don't know. And by the way, when you're talking to a regular investment advisor, if they don't know this, I'd find a new one, or tell them to listen to my show. Tell them to go to my seminars. I'm telling you, I don't like to see people struggle or suffer out there. And I've had a lot of people who we were invested in these things before they started taking off and got very disgruntled and thought that, hey, I should be making more money. Look at the stock market. You mean the S&P 500? Yeah, that's not the stock market. That's 50 stocks. Okay? It's like the Dow. It's 30 stocks. The average stock in the stock market's not been doing nearly as well as that. Neither have the international emerging market. And if you want to put all your money in the S&P, that's fine. When it has a 10-year negative time period, you're not allowed to come back crying. That's all I got to say. Don't come back crying if that's what you want to do. You always want to be in the back, because it doesn't work. And I know I've got some momentum strategies that haven't worked nearly as well because of the choppiness of the market. But now they're on fire. Why? Because the economies are running. Economies are picking up economic speed. And, we talked about all this stuff multiple times. I talk about it every seminar. But some people are just so emotional about their investing, it's going to hurt them. And I feel bad for them. I really do. I used to be in that boat. Everybody is that doesn't know it, that doesn't know a whole lot. They're just tossed around like a cork in the ocean. I want to be a schooner. Schooner still has to take the waves, by the way. And it's still, if you're going against the wind, you have to go in a zigzag pattern. Wow, I can't believe the show's over. Anyway, listen, I really appreciate you listening every week, and I appreciate all the emails and attendance at the seminars. I'll be back here next week to go over some new stuff. We'll probably have that seminar date established. We will by that point in time. You go to my website to check it out. In the meantime, if you have a question, just email me or call me, bill@bullingtoncapital.com. Have a good week, everybody. Good luck. and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.